Considerations when trading options. Let's have a look at an example. Suppose that the trader is bullish on a stock that's currently trading at $56. Therefore, the trader decides to write short or sell, they all mean the same thing, a put option in order to earn a premium income. And here's the logic. If you're bullish, you think that the stock price is going to go up. Therefore, a put option would never get exercised. So why not sell a put option and at least earn some premium income? Now let's suppose that the strike on the put is 50 and the premium for that put is $3. So when you do sell this put option, you'd make $3 in premium income. So now let's look at some scenarios. Part 1. If at expiry the spot price is less than 50, the put counterparty will exercise the put itself, and therefore the trader will be forced to purchase the underlying stock. So remember how a put works. So if you have a long position in a put, you have the right to deliver the underlying asset and get the strike price for it. Now, since you sold the put, you would take the opposite side of that, which means you would be forced to buy the underlying stock and pay the strike price for it, which is $50. But remember, you made some premium income in the beginning when you initially sold the put itself. So therefore, your total purchase price would be $47. So in effect, what's happening here is that the premium income you made is effectively reducing your purchase price for the underlying stock. And remember, the big picture, this investor is bullish. So ultimately, he does want to own the shares. And by being forced to buy the shares at the strike price and taking into consideration the premium income he received, it's reducing the price that he would effectively pay in order to purchase the stock. So the main advantage with this strategy is that, the premium income from selling the put reduces the purchase price of the stock. So this sounds great, ladies and gentlemen, but as we know, there's no such thing as free lunch. So what could go wrong with this strategy? And what I mean by that is, if you have a bullish outlook and you ultimately want to be buying the stock, what could go wrong with taking the approach of selling a put option today? Well, let's see here. Well, what if the spot price drops below 47? In that case, the trader, the guy who sold the put option, would incur a loss, because then he's still effectively paying $47, but now the stock is worth a lot less. I mean, that's exactly what we're saying. So let's do an example. So when you see an inequality on the exam, what you should do is you should just come up with a number. So what if the spot price was 30? Because that would be less than 47. So what would happen? Well, look, ladies and gentlemen, the put's going to get exercised. And when the put gets exercised, we already established that you're going to be paying a net price of $47 for that stock. Yeah, but it's only worth 30. So yeah, we're going to incur a loss. So even though you were bullish, things didn't go the way you expected it. It's possible that the spot price does drop. And that's the thing, ladies and gentlemen, whenever you sell an option, you always have to be prepared for the possibility that the option will get exercised. Because if you're the short position on an option and the option does get exercised, it's going to work against you. What's the other risk? Well, if the spot price increases, the put may never get exercised, right? Because remember, the strike price was 50. So if the spot price stays above 50, the put would never get exercised, which means you never end up buying the shares. Therefore, it's a missed opportunity. Why is it a missed opportunity? Well, let's connect the dots. The stock price went up, but you never ended up owning it. And that's what we mean by missed opportunity. Now in part 2, we're told that the put delta is negative 0.2. And remember what delta is. It measures the sensitivity of the put price in response to changes in the price of the underlying asset. And the other thing with puts is that the delta is negative because the put moves in the opposite direction to the change in the spot price. So when the spot price goes up, the value of the put option goes down. So then here it is. So as we said, the delta represents the sensitivity of the put to changes in the spot price. So if it is negative 0.2, and if the spot price goes up by 50 cents, then let's just put everything together. Here's the delta, here's the change in the spot price. Therefore, the value of the put will actually drop by 10 cents. So therefore, the long would lose, and as a result, the short would gain. That's how it works, right, ladies and gentlemen? So if you buy something, so here's the put option. If its value is decreasing, well, if you have a long exposure to it, then you're going to lose money. But if this is a liability, which is what a short position is, so if your liabilities go down in value, then of course you would gain. So therefore, what would be the new put price? Well, the initial put value was $3, and then after the price of the underlying asset changed by 50 cents, we saw that the value of the put decreased by 10 cents. So therefore, after the change in the spot price, the value of the put would be trading at $2.90. In part 3, we're told that the gamma for the put is equal to positive 0.14. And remember, gamma measures the rate of change in delta. In other words, how does delta change in response to the change in spot price? And what I always like to do with ratios, because that's what this is I like to flatten it out. So therefore, change in delta is equal to gamma times change in spot price. So if gamma is 0.14 and the spot price changes by 50 cents, then therefore the delta will change by 0.07. So therefore, if the initial delta was negative 0.2, and now we're told that the delta is changing by 0.07, that would mean that the ending delta, in other words, after the price shock, would be negative 0.13. So the best way to see what's happening here is through visual framework. And here's the profile for put options right there. So the red line represents the value of the put option itself. And initially we're told that the strike price is 50, and the initial spot price was 56, and at that point the premium was $3 for the put, and its delta was negative 0.2. But then we said if the spot price changes by 50 cents, in other words, it goes up by 50 cents, we calculated the new put value, which was $2.75. I'm sorry, correction, I meant to say it would be $2.90 as we calculated right here. And at the same time, its delta would now be reduced in absolute value terms from negative 0.2 to negative 0.13. So how do we read this information? So as the spot price increases, so again, going from S0 to S1, you can see that the slope of the red line is flattening. And that's exactly what delta measures. It's the slope of this line, because the slope here measures the change in the put price in response to the change in the spot price. So as the slope flattens, the delta itself drops. And again, we're looking at the absolute value because we know delta is negative for put. And what that indicates, ladies and gentlemen, is that the put price is becoming less sensitive to changes in the spot price as the spot price gets higher. And you can see that clearly here. So if this is flattening out, it means there isn't really much change happening to the value of the put as the spot price goes deeper out of the money, or I should say the put goes deeper out of the money. Now in part 4, we're told that the put's theta is negative 0.08, and what that means is holding the spot price and the volatility constant with the passage of time, specifically with the passage of 1 day, we expect the value of the put to decay by 8 cents. So therefore the next day, the value of the put option would be worth $2.92. Again, assuming that the spot price and volatility stays constant. And in part 5, we're told that the put's vega, or sensitivity to volatility, is 0.09. And what that means is if implied volatility increases by 1 percentage point, for example, if the volatility of the underlying asset goes from a standard deviation of 23% to 24%, so you can see that's a 1 percentage point change, then the value of the put option would increase by 9 cents. Because remember, options have a positive exposure to volatility, and we've seen this in a previous module. So as volatility increases, option value increases. So therefore, in response to this increase in volatility, again holding everything else constant, the value of the premium would increase. And as we said, as volatility increases, the option becomes more valuable, going from $3 to now $3.09. Part 6, we can see that the short put has the same payoff as a covered call. So first of all, let's plot a short put. Here's what a short put position looks like, right? So if the price of the underlying asset drops below the strike price, the long put gains, which means the short put loses. That's why we're in this quadrant. And of course, if the spot price is greater than the strike price, then the put option would expire out of the money, and that's why we have zero value. So again, the short put looks like this. However, you could see that if we combine a long asset position, which is represented by this blue line right here, with a short call position, what's going to happen here is a dollar gain here will be offset by a dollar loss there. So that's why you get that red line, which represents the combination of a long asset and a short call. But ladies and gentlemen, you could see that the two squiggly lines have the exact same identical payoff. And that's where we get the statement that a short put is equivalent to a covered call position.